At 8:12 a.m., Washington unveiled what officials described as a decisive economic move designed to force Canada back into line. Within minutes, headlines spread across trading desks, television studios, and government offices around the world. New tariffs, fresh trade restrictions, and renewed threats of tougher action were presented as proof that the administration was ready to use America's full economic weight against one of its closest partners. Supporters celebrated immediately. Commentators called it strength. Allies of the president said Canada had taken U.S. access for granted for too long and that only pressure would produce results. But by nightfall, the mood had changed dramatically. The move intended to crush Canada was beginning to crush confidence instead. The strategy followed a familiar script: use market size as leverage, increase economic pain, force concessions, claim victory. It was a model built for modern politics because it offered dramatic visuals and simple messaging: tough leader, weak opponent, fast result. Canada, with its deep trade dependence on the United States, seemed like the ideal target. Billions of dollars in goods cross the border regularly. Supply chains are tightly linked. Geography naturally favors integration. To many in Washington, the logic felt obvious. If the United States tightened access, Canada would have no choice but to yield. Yet markets immediately sensed the story was more complicated. Before the opening bell had fully settled, futures turned volatile. Investors were asking questions that politics often ignores. How would American manufacturers absorb higher input costs? What would happen to automotive supply chains crossing the border multiple times during production? Would agriculture face retaliation? Could energy markets be disrupted? How would Canada respond? In finance, confidence weakens the moment uncertainty rises. And uncertainty had arrived in force. Inside the White House, advisors defended the move as a calculated show of leverage. They argued previous administrations had accepted bad terms out of caution. This time would be different. America would negotiate from power. But leverage in economics is rarely one-directional. Canada sells heavily into the U.S. market, yes. But the United States also depends on Canadian energy, industrial materials, agricultural imports, and stable continental logistics. The border is not a wall between separate systems, it is the seam of one integrated one. Pull too hard, and both sides feel it. Canada's initial response was calm, measured, and far more dangerous than outrage. Rather than dramatic threats, officials signaled preparation. Emergency meetings were held. Trade ministers reviewed options. Industry groups were consulted. Public statements emphasized resilience, sovereignty, and strategic patience. That tone mattered. Washington was trying to create panic. Ottawa was trying to project control. In international disputes, the calmer side often appears stronger. Business leaders in both countries quickly raised alarms. Auto executives warned of cost spikes and production delays. Retailers worried about prices. Farmers feared losing market access. Rail and trucking firms watched shipment forecasts nervously. Commodity traders recalculated flows. None of them cared about rhetorical victories. They cared about margins, contracts, and schedules. Economic warfare sounds clean in speeches. In practice, it moves through invoices and payrolls. The political theater continued through the afternoon. Administration allies insisted Canada had nowhere to go and would soon return with concessions. Television surrogates repeated that the United States held all the cards. But behind the scenes, investors were noticing signals that challenged that claim. Canada had spent years expanding ties beyond one market. Europe offered trade channels. Asian demand for resources and food was rising. Critical minerals were becoming strategically valuable. Energy infrastructure discussions had accelerated. Canada was not without vulnerabilities, but it was not without options either. That distinction would soon matter enormously. International observers also reacted quickly. Other allies watched to see whether close partnership with Washington could suddenly become a liability. Rivals watched to see whether America's pressure tactics would unify others against it. Financial markets watched for something even simpler, whether policy was strategic or impulsive. If the move looked disciplined, confidence might stabilize. If it looked political and improvised, volatility would grow. By late afternoon, the answer was emerging. The Dow had swung sharply. Sector losses deepened in trade-sensitive industries. Analysts openly questioned whether the administration had underestimated the domestic cost of attacking such an integrated partner. Some warned that even if Canada eventually negotiated, the price of getting there might exceed the value of any concession won. That is the hidden danger of coercive economics. Winning can still be expensive. Then came the deeper problem. Canada was not responding like a country cornered, it was responding like a country adapting. Quiet diplomatic outreach intensified. Exporters discussed alternative buyers. Markets began reassessing who actually held leverage if diversification accelerated. What Washington saw as dependence, Canada increasingly saw as motivation to change. The central theme of the day became impossible to ignore. The move was supposed to display dominance. Instead, it exposed mutual dependence. It was supposed to isolate Canada. Instead, it risked isolating the United States from the trust of partners watching closely. It was supposed to create surrender. Instead, it created resistance. By nightfall, one truth was already visible. The strategy had been designed for television but judged by markets, and markets were unconvinced. What was meant to crush Canada had triggered a far more dangerous contest, one between political spectacle and economic reality. And in that contest, reality usually wins. From the moment Washington announced its economic attack on Canada, the plan was presented as simple, forceful, and inevitable. Use America's market size, apply tariffs and pressure, create economic pain, and compel Ottawa to return with concessions. To political supporters, it sounded like strength. To television audiences, it looked decisive. To allies of the administration, it was proof that previous governments had been too cautious and too willing to compromise. But what sounds powerful in a speech can fail quickly in the real economy, and that is exactly what happened. The strategy backfired because it was built on assumptions that looked strong on paper but weak in practice. The first assumption was that Canada needed the United States more than the United States needed Canada. At one level, this was true. Canada exports heavily to the American market, and the relationship is one of the largest bilateral trading systems in the world. But dependency in trade is rarely one-directional. The United States also relies on Canada for crude oil, electricity, natural gas, timber, aluminum, fertilizer inputs, agricultural goods, and countless industrial components. Auto parts cross the border multiple times during assembly. Food chains depend on seasonal flows. Energy systems in parts of the United States are directly linked to Canadian supply. Washington saw Canada's dependence clearly. It underestimated America's own. That mistake mattered immediately. The second assumption was that pressure would create surrender rather than adaptation. Economic coercion works best when the target has no credible alternatives, but Canada was not trapped. Over years, it had quietly expanded trade access through other agreements, strengthened ties with Europe, deepened links with Asian buyers, and increased its strategic relevance in energy and critical minerals. That meant Ottawa did not need to eliminate U.S. dependence overnight. It only needed enough alternatives to make resistance worthwhile. Once Washington escalated, Canada had an incentive to accelerate diversification. In trying to increase leverage, the White House may have reduced it. The third flaw was misunderstanding modern supply chains. Trade disputes used to be easier to frame as one country hurting another. Today, production systems are integrated across borders. A tariff on imported metal can hit domestic manufacturers. Restrictions on components can slow American factories. Border delays can raise prices for U.S. consumers. Pressure aimed abroad often returns home through costs, shortages, and weaker margins. Markets understood this faster than politics did. Investors began selling companies exposed to manufacturing, transport, agriculture, and retail because they knew the damage would not stop at the border. It rarely does. Another reason the strategy backfired was psychology. Public threats can rally a domestic political base, but they often harden foreign resistance. No government wants to appear bullied into concessions on camera. Once the conflict became highly public, Canada's leaders had less room to quietly compromise. Conceding under pressure would look weak domestically. Standing firm would look sovereign. Washington's rhetoric may have narrowed Canada's political options until resistance became the easier choice. This is a common error in negotiation. Confuse public pressure with private leverage. They are not the same thing. There was also the issue of timing. Global businesses had already spent years learning painful lessons about concentration risk. Pandemic disruptions, shipping chaos, inflation shocks, and geopolitical tensions pushed firms to diversify suppliers and routes. The world was already moving toward resilience. By attacking a stable partner like Canada during that shift, Washington may have accelerated decisions already underway. Companies that once relied on old systems began exploring new ones faster. Instead of preserving influence, the strategy risked encouraging long-term workarounds. Credibility costs made matters worse. Markets and governments can tolerate tough tactics if goals are clear and execution is disciplined. But if objectives seem to change, threats appear impulsive, or costs rise without visible gains, confidence erodes quickly. Other allies begin asking whether they could face similar treatment. Investors start demanding a risk premium for unpredictability. Counterparties negotiate with one eye on diversification. In global economics, trust is an asset. It can be damaged faster than it can be rebuilt. Canada's calm response contrasted sharply with Washington's confrontational tone. That comparison did not help the White House. Supporters of the administration argued that short-term pain was worth long-term leverage. In some cases, that can be true. But only if the target lacks options, domestic costs remain manageable, and the strategy improves future bargaining power. Here, the opposite signs were appearing. Canada had options, domestic industries were feeling pressure, and future bargaining power was weakening as allies watched the fallout. Even politically, the move carried risk. Strong rhetoric raises expectations of victory. If results do not follow quickly, the same rhetoric amplifies failure. A quiet strategy can fail quietly. A loud strategy fails in public. As Canada began signaling new partnerships and markets reacted nervously, the contrast became painful. The move sold as dominance was now being described as a miscalculation. That narrative is hard to reverse once investors adopt it. In the end, the strategy backfired for one simple reason: it treated interdependence like dependence. It assumed one side could inflict pain without receiving it, that pressure would freeze choices rather than create new ones, and that economic networks were weapons rather than relationships. But modern trade is more complex than that. Countries adapt, markets reprice, partners diversify, and when leaders underestimate those realities, leverage turns into liability. What was supposed to weaken Canada instead strengthened its incentive to evolve. What was supposed to showcase American power instead exposed its limits. What Washington expected to be a slow surrender turned into something very different. Instead of returning to the table under pressure, Canada responded with discipline, speed, and strategy. While headlines focused on tariffs and threats coming from the United States, officials in Ottawa were building a countermove that few in Washington fully anticipated. It would not come through dramatic speeches or emotional retaliation. It would come through markets, partnerships, and leverage. And when it arrived, the narrative shifted instantly. Canada was no longer the country under attack. It was the country winning big. The first sign came through diplomacy. Rather than matching every American threat word for word, Canadian officials quietly accelerated talks with foreign partners who had already been looking for stable alternatives in an uncertain trade environment. Europe, Asia, and key commodity importing nations were watching the dispute closely. Many saw an opportunity. Canada offered something valuable in a world of rising geopolitical friction: reliability. It had energy resources, agricultural exports, industrial metals, critical minerals, advanced manufacturing capacity, and a legal system investors trusted. In modern trade, reliability can be worth more than raw size. Ottawa understood that. While Washington tried to force concessions through pressure, Canada positioned itself as the dependable partner others could work with long term. Then came the breakthrough announcement. Canada revealed a major trade and investment framework with external partners that expanded market access, deepened supply chain cooperation, and opened new channels for future exports. The exact terms mattered, but the symbolism mattered even more. This was proof that Canada had options. The country many assumed was trapped by U.S. leverage had just shown it could widen the board and change the game. Markets reacted immediately. The Canadian dollar strengthened as traders priced in improved growth prospects and stronger confidence. Export-linked equities rallied. Transportation, rail, port infrastructure, and resource companies saw renewed interest. Analysts upgraded outlooks for sectors tied to shipments, commodities, and manufacturing diversification. The message from capital markets was blunt. Canada had not been weakened. It had become more strategically valuable. Domestic politics shifted as well. Canadian leadership, initially portrayed by critics as vulnerable to American pressure, now looked composed and effective. By refusing to panic and responding through policy rather than outrage, officials had turned an external threat into an internal victory. Business groups that feared instability now praised the rapid search for new markets. Provincial leaders emphasized jobs, investment, and economic resilience. Public sentiment hardened around a familiar national instinct. When pushed too far, Canada tends to unify. Washington may have underestimated that. There was another reason the countermove landed so hard. It exposed a misunderstanding at the heart of the original strategy. Economic pressure assumes the target has fewer alternatives than the attacker. But Canada was not a small, isolated economy with no room to maneuver. It is resource-rich, institutionally stable, geographically connected, and integrated into multiple global demand chains. Nations need energy. Nations need food. Nations need minerals used in batteries, technology, and defense systems. Canada sells all three. That creates leverage of its own. The White House had focused on what Canada needed from America. It had paid less attention to what the world needed from Canada. Supply chains added another layer. Manufacturers around the globe had already begun diversifying production and sourcing after years of shocks. Pandemic disruptions, geopolitical tensions, and inflation had taught companies not to depend on single routes. Canada's pitch fit perfectly into that moment. Stable governance, reliable contracts, abundant resources, and proximity to U.S. logistics networks made it an attractive node in a world seeking redundancy. In effect, the pressure campaign may have advertised Canada's value to new partners faster than any promotional campaign could have. American industries noticed too. Some U.S. firms quietly worried that forcing Canada outward would create long-term competitive disadvantages. Once trade corridors are built, contracts signed, and investment relationships formed, they do not simply disappear because politics changes later. New habits become new systems. If Canada successfully deepened ties elsewhere, portions of that commerce might never fully return. What looked like short-term leverage risked creating long-term reorientation. Media coverage turned brutal for Washington. International outlets framed the moment as a strategic backfire. Commentators described Canada as calm under fire and opportunistic under pressure. Financial networks highlighted market gains north of the border while U.S. sectors tied to trade volatility struggled. The visual contrast was devastating, one side threatening, the other expanding, one side improvising, the other executing, one side talking about strength, the other demonstrating it. This is how power often changes in the modern economy, not through dramatic collapse, but through better adaptation. Canada did not need to defeat the United States. It only needed to reduce vulnerability and increase optionality. That alone can reverse leverage. Every new buyer weakens an old threat. Every new investment deal lowers the cost of resistance. Every calm response to aggression raises credibility. By the closing bell, the verdict was increasingly clear. The move designed to squeeze Canada had given Canada momentum. Pressure had produced innovation. Threats had produced partnerships. Attempts to isolate had created new access. Canada had struck back not with noise, but with strategy. And in a world where markets reward resilience, that was enough to win big. The moment Canada's counterstrike became clear, financial markets reacted with the speed and brutality only modern money can deliver. What had started as a political confrontation was now turning into an economic verdict. Traders were no longer debating rhetoric, campaign messaging, or who sounded stronger at a podium. They were calculating winners, losers, costs, and credibility. And once those calculations began, the screens across Wall Street changed fast. Red numbers spread through key sectors, volatility surged, and investors rushed to reposition before the damage moved further. This was no longer about headlines. It was about capital fleeing uncertainty. The Dow Jones Industrial Average dropped sharply in early trading as industrial names, transport companies, and manufacturers came under immediate pressure. Investors understood something Washington had underestimated. Canada is deeply woven into the American economy. Parts cross borders. Raw materials move daily. Energy flows constantly. Trucks, rail lines, pipelines, and ports link both countries in ways speeches cannot undo. When tension rises between such integrated partners, markets assume friction costs will follow, and friction costs eventually become lower profits. The S&P 500 also weakened as broader anxiety spread across sectors. Companies with direct Canadian exposure were hit first, but the selling quickly widened. Retailers worried about import costs. Food companies watched agricultural supply chains nervously. Construction firms monitored materials pricing. Airlines and logistics operators studied fuel and freight implications. Once markets sense policy confusion, they rarely keep fear neatly contained in one corner. It spreads through expectations. The Nasdaq reacted with sharp swings of its own. Technology firms were less directly exposed to Canada than automakers or manufacturers, but investors still marked them lower because valuation depends on confidence in the broader economy. If trade conflict slows growth, raises costs, or weakens consumer demand, even sectors far from the border feel pressure. Markets price future earnings, not present comfort. When future visibility declines, multiples contract quickly. Bond markets delivered a colder message. Treasury yields shifted lower as investors moved money toward perceived safety. That kind of move often reflects caution rather than panic. Stocks can overreact emotionally. Bond markets tend to react analytically. When bond traders start preparing for slower growth or increased instability, policymakers usually take notice. On this day, they had reason to. Currency markets added another layer of embarrassment for Washington. The U.S. dollar traded unevenly as investors weighed safe haven demand against growing concerns about policy credibility. Meanwhile, the Canadian dollar found support and in some sessions strengthened noticeably. That was symbolically important. The country that was supposed to be weakened under pressure was now being treated by markets as comparatively resilient. Traders were effectively saying Canada may emerge stronger from the confrontation than expected. Sector moves told the deeper story. Auto stocks fell because North American manufacturing depends on synchronized supply chains. Any disruption raises costs and delays production. Agriculture-related names weakened on fears of retaliatory measures or lost export share. Railroads and freight operators faced uncertainty over volumes. Home building and industrial firms watched metals, lumber, and materials pricing closely. Energy companies moved sharply as investors reassessed cross-border flows. In a continental economy, no major sector is truly isolated from trade tension. Financial television exploded into non-stop coverage. Anchors described a market rebuke to Washington's strategy. Analysts debated whether the White House had misread Canada's leverage. Some argued the reaction was temporary noise. Others said it reflected a more serious issue. Confidence in U.S. economic management was being tested publicly. That distinction mattered. Markets can recover quickly from one bad policy decision. They recover more slowly when investors begin doubting the decision-making process itself. Business leaders quietly echoed the concern. CEOs can plan around taxes, labor costs, regulations, and competition. What they struggle to plan around is uncertainty that changes by tweet, press conference, or sudden decree. Should they expand a plant, delay hiring, shift sourcing, increase inventories, cut forecasts? Every unanswered question slows investment. That is why markets react so strongly to unstable rules. It is not drama, it is math. There was also a powerful contrast before and after Canada's move. Before the counterstrike, many traders believed Trump's pressure campaign might end in quick concessions. After Canada announced new partnerships and markets saw evidence of alternative pathways, the story changed. Pressure no longer looked like leverage, it looked like miscalculation. Canada no longer looked cornered, it looked adaptive. That narrative reversal can be devastating because markets price momentum as much as fundamentals. A Buffett-style lesson hovered over the day. Markets can handle conflict. Markets can even handle bad policy. What they struggle with is a strategy that fails publicly while creating uncertainty privately. Investors can calculate tariffs. They can model slower growth. But they cannot easily model improvisation layered on top of misjudgment. By the closing bell, some losses had narrowed while others deepened, but the message was unmistakable. Capital had voted. The move meant to pressure Canada had instead pressured confidence. Wall Street was not reacting to politics alone. It was reacting to the possibility that strategy had broken down in full view of the world. In Washington, leaders can argue over narratives. In markets, numbers speak faster, and on that day, they spoke instantly.